Warren Buffett's 3 Simple Rules for Beginners to Invest Wisely. Join me as I try to follow Warren Buffett's 3 simple rules and see if I can make smart investment choices as a beginner. What if I told you that 3 simple rules could change the way you invest forever? These are the same rules that helped Warren Buffett become one of the richest investors in the world. But do they actually work? Today, I'm going to break down these rules and see how beginners like us can use them to make smart investment choices. Let's get started. Warren Buffett is widely considered one of the greatest investors of all time, with a net worth of over $90 billion. He's known for his value investing philosophy and his ability to generate impressive returns over the long term. Today, I want to share with you his 3 simple rules for beginners to invest wisely, and explore how we can apply them to our own investment journeys. When it comes to investing, many beginners face a range of challenges that can make it difficult to get started. One of the biggest obstacles is lack of knowledge. It's easy to feel overwhelmed by the sheer amount of information available, and to worry that we're not making the right decisions. Another common challenge is fear of loss. The fear of losing our hard-earned money can be paralyzing and can stop us from taking action. Additionally, the amount of information available can be overwhelming, making it difficult to know where to start. And finally, many of us struggle with emotions. We get caught up in the hype of a particular investment, or we let our fear of loss cloud our judgment. These challenges can be daunting, but they're not insurmountable. By following Warren Buffett's 3 simple rules, we can overcome these obstacles and start making informed investment decisions. So what are these rules, and how can we apply them to our own investment journeys? Rule number 1, only invest in businesses you understand. This rule is all about doing your research and having a deep understanding of the companies you're investing in. For years, Buffett avoided tech stocks, even when companies like Microsoft were booming. Why? Because he didn't fully understand the tech industry. Instead, he focused on simple, easy-to-understand businesses like Coca-Cola, Geico, and See's Candies, companies that made sense to him. Now think about beginners investing in Tesla or cryptocurrency without research. They might be investing based on hype rather than understanding. Stick to your circle of competence. If you don't understand how a business makes money, it's best to stay away. How to research a company? Read annual reports, understand the business model, and ask yourself, would I be comfortable explaining this company to a friend? Rule number 2. The second rule is to only invest in businesses with strong financials. This means looking beyond hype and focusing on real numbers. Buffett didn't buy Apple stock until 2016, even though it was a huge company. Why? Because he waited until its financials were strong, consistent profits, strong cash flow, and low debt. So, let's break it down. Simple explanation of financial health. Low debt equals stability. High profitability equals sustainability. And return on equity, or ROE, shows how well a company uses its money. For beginners, here's a checklist. Look at earnings growth, check debt levels, and avoid companies with negative cash flow. Now on to rule number 3. This one's really crucial. Have a long-term perspective. Warren Buffett, for instance, believes in holding stocks for years, sometimes even decades. The stock market, folks, is designed to transfer money from the active to the patient. Buffett bought Coca-Cola stock in the 1980s, and he still owns it today. That's the power of patience. Why long-term investing beats day trading: compound interest effect. Avoid emotional decision-making. The stock market always has ups and downs, but history shows it grows over time. Would you rather make quick money or build long-term wealth? Comment below. As Buffett has said, price is what you pay. Value is what you get. This quote encapsulates his investment philosophy beautifully, and it's a powerful reminder to focus on the underlying value of a company, rather than just its stock price. For beginners, this quote is especially important, because it's easy to get caught up in the excitement of a rising stock price, or to panic when the price falls. By focusing on value, rather than price, we can make more informed investment decisions and avoid getting caught up in the emotions of the market. By following these 3 simple rules, beginners can overcome the common challenges of investing and start making informed investment decisions. By only investing in businesses we understand, doing our due diligence on financials, and taking a long-term perspective, we can start building wealth over time. Remember, investing is a journey, not a destination, and by following Buffett's rules, we can set ourselves up for success in the long run. So, let's recap Buffett's 3 simple rules for beginners. Only invest in businesses you understand. Only invest in businesses with strong financials. Have a long-term perspective. The stock market isn't a casino. If you follow these 3 rules, you can start investing wisely and build wealth over time, just like Warren Buffett. Which of these 3 rules do you find hardest to follow? Let me know in the comments. Thanks for watching. If you have any thoughts on Warren Buffett's 3 simple rules, please share them in the comments below. And if you're interested in learning more about investment strategies or financial literacy, be sure to check out our next video. Don't forget to like and subscribe for more content on personal finance and investing.